Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Alasdair Macleod, one of our most favored guests. He writes frequently. I think almost every week you can pick up an article that he writes at goldmoney.com. And I would suggest those of you out there who care two hoots about what's going on in the economy, in the markets, you better do that, because Alasdair provides some great insights into not only what is happening, but why it's happening and why it's likely to happen in the future. So thanks for joining me again, Alasdair.
That's very much my pleasure, Jay.
Always good to have you with us. I want to ask you about an article that you just wrote. It's posted up there now. I guess people can read it at Gold Money, The Forthcoming Global Crisis. And you started out in the article by saying, and I quote, "Ever since the last credit crisis, 2007-08, the next crisis has been anticipated by investors." Now, I have to ask you, Alasdair, where is your faith? Where is your faith in the PhDs from Princeton, Harvard, and Yale? How dare you question them? They most certainly have fixed things, and tell us why you don't believe that.
Well, I think you know the answer to that one, Jay. The answer really is quite simple. They follow a line of reasoning which was embodied in Keynes' general theory, which is complete nonsense. The first thing that Keynes did with his general theory was deny the validity of Say's law. He defined it incorrectly. Basically, what Say's law says is that we produce things in order to consume. And, money is merely the, if you like, the intermediary between our production and the goods we buy. And you cannot produce more, if you like, in a community than you can't produce more than you buy, and equally, you can't buy more than you produce. If you do, then basically some fake money has to be introduced into the system. And that's really the problem we have today. And that's why we have trade imbalances, budget imbalances, and all the rest of it. And the idea that you can stimulate the economy by encouraging consumption, by expanding bank credit, to try and get the economy going is completely fallacious, because all you do is you lock yourself into a credit cycle. And this was the nub of my argument. We all work on a credit cycle. It's not a business cycle. Well, you could call it a business cycle, but it is driven by credit. So call it a credit cycle.
Right.
And you've got very distinct phases. You have a crisis from the last cycle. And in that crisis, the central bank moves from trying to slow down the rate of inflation, slow down the rate of monetary growth, raise interest rates to try and cool the economy down because things are getting out of control. They raise the rates to the point where suddenly all the business models that were predicated on lower interest rates start going horribly wrong. And as well as that, you've inevitably got a legacy of debt which is completely unaffordable from business models which actually should never have been undertaken in the first place. So you get a crisis. And so the Fed, or whichever the central bank is, then turns round 180 degrees and tries to support prices to stop them falling, because they believe that falling prices are bad. They're not, actually. It just clears the market. Anyway, we'll give them that one. But then the next phase is a phase of recovery. And during that recovery, we are all terribly worried, because we remember what happened 5 minutes ago. We remember how, there was that awful moment where we were looking at the banking system. We suddenly thought, my goodness, we're going to lose everything. This is terrible. How are the banks going to open tomorrow? What is going to happen? And that is still fresh in our minds. And there's always some disaster round the corner for us to worry about, whether it's Europe or Cyprus or, Spain or Italy. I mean, you've got all these crises going on at any one moment. And, of course, it's a very good reason for the market to collapse and for disaster to happen. But no, this is what recovery is all about. And someone once described that such a market as a wall of worry. And during that wall of worry, of course, you get low interest rates. Money starts trickling into into financial assets. So your bond yields fall, your share prices rise. And then at some stage, this turns into an expansionary phase, because suddenly the bankers realize that actually there isn't so much risk in the economy. because the economy is actually going quite well. So we'll increase our lending to the economy. But in order to do that, they sell down their government bonds because they've bought government bonds, short-term government bonds, as a risk-free alternative in a very risky world. So they switch from owning financial assets into lending to business. And the effect of that is to drive yields on government bonds up. And at that stage, equity markets start going down. We haven't quite got to that stage yet, but we're getting to that stage. And then, of course, the economy really looks good, but it's going too quickly. It's been overstimulated. And inevitably, you start running into bottlenecks, shortages, prices start rising. And then guess what? The Fed has to put up interest rates again, and you get the next credit cycle. So the next credit crisis. And that, I think, is what we've got ahead of us. And my best guess at this stage, and my view will change, I give due warning, but my best guess at this stage is that it's likely to be in the second half of next year that this crisis occurs. And the reason I picked that timing is I'm looking at Europe in particular, because Europe is beginning to go like a train. The German economy is it's very, very strong indeed. Even economies such as Italy and Spain and so on are beginning to pick up now. They're getting into sort of expansionary mode. So, the economic runes tell me that we've probably got about a year of this, something like that, before it goes wrong. But before we get there, the first thing that's got to happen is we've got to get a reversal of monetary expansion from the ECB. The ECB has to stop negative interest rates on bank deposits on its own balance sheet. It's got to stop this 60 billion euros a month asset purchase programs. It's got to actually raise rates to something positive. Now, that, I think, is going to be quite a big shock in the Eurozone government bond markets. Because if you look at the Schacht bond, which is the 2-year German government bond, that yields a minus 0.68%. I mean, this is completely ridiculous, completely mispriced. It's mispriced because of what the ECB has been doing. So I think there is, if you like, a shock as that gets sorted out. And I think that's going to mark the turning point for our equity markets, which is the first one to fall, well, the second one to fall, because bonds have already turned some time ago. So equities are the next one. You'll then find that the economy as a whole will look pretty good. And a lot of amateur investors will say, well, we should be buying equities because companies are coming in with better than expected profit forecasts. It's all looking very good. But all this is done on expansion of bank credit. And then you have the third crisis. And the third crisis is industrial assets suddenly start getting into trouble. And amongst those industrial assets are property. And if you look back to the last crisis we had in 2007-8, it was property that undid the whole thing. So we've still got that to go through, in my opinion. What we have to take on trust, however, is that all these sort of distortions and so on and so forth, and all the problems, somehow the central banks will muddle their way through it. They'll kick the can down the road, if you like. But the one thing they can't do is stop that final credit-driven crisis. So that, I think, gives us, if you like, a roadmap and an eventual end time on when this is likely to happen.
Well, certainly things are getting better in Europe. I think Mrs. Taylor and I just returned from Portugal, and in our discussions with people, the general consensus is things have gotten somewhat better. It's not booming yet. So do you think that Europe is getting close to that point where the central bankers are going to realize they have to tighten up or stop being so promiscuous with their money creation?
I think stop being promiscuous is probably the first stage, and I would expect that by the end of this year, yes. Now, the reason that Europe is going like a train is it's really partly, because things are getting better, as it were. But remember that we've got China, which has had a massive program of expanding trade throughout the Eurasian continent. And now, I think I've said this on your show before, you can put a Mercedes on the train in Stuttgart and have it in the showroom in Beijing in 15 days. Mm-hmm. And equally, the white goods manufacturers in Europe who make all their stuff in China, they can put their white goods in containers and get it in the showrooms around Europe, again, within 15 days. And that time is coming down, and it's planned to come down to under 10 days. Mm. So, this is enormous stuff, and China is going to spend an awful lot of money. It's going to cause a lot of money to be spent developing the whole of the Asian continent. There's an industrial revolution there, and of course, Europe, the EU, the Eurozone, is going to be very much affected by this, and this is why I think it's caught everybody by surprise. We all know that the banks in Italy are in trouble. We know that Deutsche Bank has had a hell of a time, and all the rest of it, and Portugal, your wife's stamping ground. They've had the most ghastly time, and Greece, and so on. But we forget in all this that actually, underlying it, there has been this pickup in business, and things have progressed, and they continue to progress. So I think the ECB has just got itself completely wrong-footed in this, and is going to have to do a volte-face by the end of this year. Now, that is going to create a financial shock. Of that, I'm sure. But I believe that the ECB will pick up the pieces. And I was interested to see, incidentally, that only tonight Mrs. Yellen has said that perhaps we've got to be a bit more aggressive on interest rates. That's not quite her words, but that's what she was saying. And this to me smells like preparing the ground for a shift, if you like, in international central bank policy, if I can put it that way. I've been writing for a long time that interest rates in America are far too low. It's completely ridiculous. But the problem that the Fed has is that if they raise the Fed funds rate to somewhere over 2%, because of the huge amount of debt in the economy, not least government debt as well, then that in itself is probably enough to create the credit crisis. So it's actually quite a fine line we're walking here, I think, between, the economy is sort of all right, it's expanding, but raise the interest rates not very much, and suddenly you're in crisis. So it's going to be a very, very difficult time. But I do see that the central banks have got to turn around and recognize that their economies are growing. The US economy, incidentally, is growing at a very subdued rate compared with elsewhere. But that's because you've got no benefit from the China story whatsoever. Britain has. Europe has, Japan has, South Korea has. If we put the Korea problem to one side for the moment, the whole of Southeast Asia has. All the commodity suppliers like Australia and Sub-Saharan Africa, they are supplying these commodities, and so they are doing quite well as well. The only country really that's a laggard in this is the one that has the reserve currency, which is an interesting point, and that's America.
That is a very interesting point. And certainly this trade with China isn't being improved under the Trump administration, I would suggest.
No.
From the United States perspective, Well, let me ask you, Alasdair, let me just try to understand, because I think one of the insights that you helped me with recently was an understanding why the banks would feel compelled at some point to sell their treasuries and safe assets and start lending. As you mentioned, they're not fearing any longer the economy. It has gotten better. Obviously, 7-8 years since the last crisis, people forget. It tends not to be as vivid in their memory, the pain that took place then. And so, but I guess if banks are holding treasuries and they see rates starting to rise, it's a losing proposition to hold them, isn't it? So they dump the treasuries, therefore causing rates to rise even further. But then they have money that they lend out into the economy, therefore stimulating the economy, which is already growing even more, thereby causing prices to rise, which then causes the central banks to think they have to pull back even more, or at least not create money as rapidly as they were before. But on the other hand, you've got the governments that have this tremendous debt, more than ever, $20 trillion in the United States, and your interest rates start going up, and they have to start paying more for the bond. I mean, this is really a bad situation that we're in, isn't it?
Well, it happens every cycle, just as you've described it, Jay.
But they're getting more advanced. They're getting more. It seems to be more and more faster and faster, though, Alasdair.
Well, I think
Each
bigger
cycle.
and bigger
Yes.
and bigger is a concerning thing, because the success of the central banks basically has been to stop debt liquidation. The result is that every cycle starts with a higher level of debt than the previous cycle, and consequently, when at some stage, this whole thing is just going to be completely uncontrollable. But I think that what will happen on the next credit crisis is that the central banks will throw so much more money at the problem, because the one thing they don't want to see is prices fall, and prices will fall if you get a contraction of bank credit. So they will make up for all contraction of bank credit by producing more base money, by doing QE on a scale like you've never seen before. Yeah. We thought it was enormous last time. It's going to be bigger this time. But I think the inevitable consequence of this next time is that somewhere down the road, maybe over the next 2 or 3 years, following 2018, if my timescale is right, we're likely to get the destruction of paper currencies. Because you can't just flood everything with, yet more and more money and expect prices not to reflect that expansion in the quantity of money. So I can certainly see that this time round there is a very good chance that the actions of the central banks will actually end up destroying their own currencies.
Wow, that's a pretty frightening thought. But on the other hand, Alasdair, I think what you're saying, the insights that you're providing here, and those of the Austrian school that understand these dynamics that you're talking about, it also provides an opportunity for people that understand this, because certainly the mainstream media certainly doesn't understand it. The mainstream economists don't understand it. But this is reality. I mean, you and I have been around long enough to see several of these cycles, and we know it's true. So the point is that we can take advantage of this, can't we? I mean, we can. Yes. We can actually profit from this nonsense that's going on, not to try to take advantage of the miseries of everyone else, but simply to protect ourselves and our families, right?
I think if you understand what's going on, then I think the first thing you can do is you can, if you like, angle your investment portfolio accordingly. So when I mean investment, I would think, there's a time to buy into gold mines, for example. So that's the sort of thing I would look at as an investor. But I think there is a secondary point which we must understand, and that is that when currencies are being destroyed, you need to protect yourself. It's protecting yourself and your family. This is really what it then becomes about. And at that stage, what you must do, I think, is hold the one form of money which governments cannot print, which governments cannot issue, and that is gold.
That is gold.
Silver. Yeah. I mean, silver, if you like, is I suppose a little bit of a speculative version of gold, but it's got the same characteristics of gold. But gold, if you like, is the last true money, sound money in existence. And indeed, our paper currencies owe their existence to having started off as a substitute for gold.
Well, that's true.
And so, when they get destroyed, what have you got? You've only got one thing, and that is gold. Yeah.
Alasdair, we're going to have to leave it go at that. I cheated you on the time again. Thank you so much for your insights. Always great to hear from you. Hopefully we'll have you back again sometime in the near future. Thank you so much.
That's my pleasure, Jay.